Well, the Fed finally did it.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point.
They cut the federal funds rate by 50 basis points as of September 18th. While this brings great news, it's great hope for the would-be home buyers who are looking to jump into the market to buy a house. I wouldn't say that this is going to fix this broken housing market that we've had over the past few years. This is the first federal funds rate reduction we've seen in 2 years, which is really amazing, and people are excited about it. But I want to bring everyone back down to reality a little bit, and let's talk about how this is going to impact buyers, sellers, home builders. And I'm going to share with you why this is not going to fix the housing market for the short term. And even Jerome Powell agrees with me. And I'm going to share his thoughts on what he feels about what's going on with this housing market. And I'm also going to share with you some tips on what you should be doing right now if you're planning on buying a home over the next 6 months to a year, what you need to be doing to get ready for that. So let's get started. I first want to talk about the federal funds rate and the connection to mortgage interest rates. There is some confusion out there. People think that when the Fed cuts the federal funds rate, it automatically reduces the mortgage interest rates. They're not connected to each other. They're connected indirectly. And let me explain. The Federal Reserve sets that federal funds rate. That's the interest rate that banks charge each other for overnight loans. The rate is also a tool for controlling inflation and economic growth. You may recall at the beginning of this year, the Fed was talking about cutting the federal funds rate several times over this year, and that didn't happen until September. Why? Because inflation still remained high and remained high for a longer period than what they were anticipating, so they didn't cut that federal rate until September. Now, that federal funds rate does not directly impact the mortgage interest rates. Mortgage interest rates are tied to the yield of the 10-year Treasury bond. So that's what banks are observing, not so much the federal funds rate. You may have seen the weeks leading up to the Fed's announcement of cutting this interest rate, the banks were already lowering the mortgage interest rates. The reason being was that there was speculation that the Feds were going to cut the federal funds rate and the economy was looking to be a little bit more stable. So the banks were growing more confident in the economic situation. Therefore, they started to reduce the mortgage interest rates. So let's break this down right now. What does this mean for somebody who's buying a house right now if they're going to get a mortgage today versus if they were getting one a year ago? So to keep this simple, let's use the example if you're buying a $500,000 house. You put 20% down, so therefore you're financing $400,000. Now, a year ago, interest rates were hovering around 7%. So your mortgage payment, which is just your principal and interest, I'm not including taxes and insurance in here, principal and interest, that monthly payment was $2,661.21. Now, fast forward to today, rates are hovering around 6%, the low sixes. So for this example, I'm just going to say 6% because I did find on Freddie Mac that mortgage rates are at 5.99%. So let's say 6%. That mortgage payment, principal and interest, would be $2,395.63. So that's a savings of $265.58. Not a huge reduction, but it's a start. That gives a lot of people hope, being that these interest rates are coming down, therefore making the mortgage payments a little bit more affordable. Now, there is talk that they are going to do another cut to the federal funds rate in December, and then they're projected to do more over next year in 2025. As these conditions are improving in the economy, the banks are probably more apt to lower those mortgage interest rates even more. Some are speculating it could end up in the 5% range. Some are saying it's still going to hover in the 6% range going into next year, but one doesn't know for sure. So this is all speculation from the analysts. Another positive impact is on the sellers. Yes. So people who are thinking about selling their home, this reduction in the mortgage rates is promising for them because a lot of these sellers have been locked in over the past couple of years. Locked in, meaning they're locked into their low interest rate. 60% of Americans who have mortgages have interest rates of 4% or lower. In the past couple of years with the higher interest rates, sellers were not giving up that lower interest rate just in order to buy another house and to pay a higher interest rate. Wasn't happening. Now that these rates are coming down, more sellers will be more inclined to list their homes, therefore increasing inventory, which is a good thing. Another positive impact of these lower rates is with the home builders. Now, according to the National Association of Home Builders, With the cut of the federal funds rate, home builders are growing more confident, and which means they're going to turn around and want to build more houses. So this statement from the National Association of Home Builders says here, builder confidence in the market for newly built single-family homes was 41 in September, up 2 points from a reading of 39 in August, according to the National Association of Home Builders. This breaks a string of 4 consecutive monthly declines. With inflation moderating, the Federal Reserve is expected to begin a cycle of monetary policy easing this week, which will produce downward pressure on mortgage interest rates and also lower the interest rates on land development and home construction business loans. Okay, this was all well and good, but is this going to fix this broken housing market? And even our friend Jerome Powell doesn't think that the lower interest rates are going to fix this market. So here's the one negative thing that's going to happen. Now, the mortgage rates are coming back down. More people are going to want to enter the market because in the last couple of weeks, mortgage applications have risen substantially. So what's going to happen? It's going to create more competition between buyers. There's still low inventory, and that means there could be bidding wars and prices are going to rise. Now, are they going to rise to what we experienced the past few years? Hopefully not, but it still can happen. So don't expect prices to come down in the next 6 months or even a year. Even though these lower interest rates can prompt sellers to get off the fence and sell their homes, it's prompting the builders to go out and build more homes. It's going to take time for that inventory to build up to meet the demand. And honestly, a lot of experts are saying that could be years for that to happen. Even Jerome Powell has said lower interest rates is not going to solve the housing problem. Back in March, Jerome Powell spoke in front of Congress, and this is what he had to say. The housing market is in a very challenging situation right now. You have this longer run housing shortage, but at the same time, you have a bunch of things that have to do with the pandemic and inflation and the Fed's response with higher rates. You have a shortage of homes available for sale because many people are living in homes with a very low mortgage rate and can't afford to refinance, so they're not moving, which means the supply of regular existing homes that are for sale is historically low and a very low transaction rate. That actually pushes up the prices of other existing homes and also of new homes because there's just not enough supply. The builders are pushing, but they're running into all kinds of supply issues still around zoning and workers and things like that. I will say the first problem is a long run problem. The other problems associated with low rate mortgage, the lock-in and high interest rates and all that, those will abate as the economy normalizes and as rates normalize, but we'll still be left with the housing market nationally where there is a housing shortage. He's even saying that we need more houses. We need more houses to be built. And I've said this before on my channel and many of my videos. In order for that to happen, there need to be some changes in zoning and regulations with the local governments. Maybe there needs to be some type of incentives towards builders, like tax incentives or what have you, to get more homes built in this country. Hey, if you're looking to make a move and you need to be connected to a real estate agent in your area, whether you're buying or selling a home, feel free to reach out to me. Click that link below, fill out the form, and I will get back to you within 24 hours and I will get you connected to a great agent in your area. Next, I wanted to give you guys some advice on what you should be doing right now if you're thinking about buying a home, say within the next year. And I want to take a moment to say thank you to the viewers who've been reaching out to me. They've been emailing me, you've called me, and I'm getting asked the same question. Is the market going to improve in the spring? Should I wait until then? Should I buy now? Here is what I can tell you, and this is what I tell everybody who's reached out to me. You need to evaluate your own personal situation, your personal financial situation, meaning that if you have money saved for your down payment, your closing cost, and you have an emergency fund of 3 months of your income, and if your life situation is presented to you where you need to get a bigger space and you feel now's the time to buy a house and you're done with renting, if those things all line up, then it's time for you to consider buying a house. Do not chase the market. Do not chase the interest rates. It all comes down to your personal situation and your financial situation. And I want to go back and stress the importance of having that emergency funds already established before you even get a house. Reason being is what I have been reading a lot lately is that people who purchased homes over the past few years, they want to take advantage of the interest rates. Good on them, but they're house poor. Why? Because they didn't take into account that things could break in the house after you move in. Guaranteed it's going to happen. And there's also been an increase in insurance rates and in property taxes, and people were not prepared for that either. So I think it's very important that you have some type of emergency fund established before you even shop for a house, because guaranteed those expenses are going to come up after you close, and you want to be prepared. You don't want to be house poor, or God forbid, get into a worse situation where then you can't make your mortgage payments. Well, the low interest rates is great news, and it is bringing hope. For right now, I don't think this is going to fix this broken housing market. I hope you take my advice and you start planning accordingly to get yourself in a position where you're actually financially ready to buy a house. Did you know that back in June, there were 56,000 real estate contracts that were canceled? I know, crazy, right? You want to know more about it? Watch this video right here. Thank you so much for watching me today to get your dose of real estate reality. My name is Jackie Baker, and I will see you next time.